Nowadays, does it feel like everywhere you look, someone is always warning of a market crash? Every headline, every YouTube video, and every so-called expert seems to be saying the same thing.
Stock market crash.
Crash the markets.
And honestly, it is hard not to listen because these warnings sound convincing. They are urgent, backed by charts and real data, and delivered with the kind of confidence that makes you think they must know something you don't. After all, if you had listened to the right predictions in the past, you could have not just avoided some of the worst crashes in history, but even turned them into life-changing opportunities. Take Michael Burry for example. In 2008, he bet against the US housing bubble and positioned his fund for a market collapse. When the S&P 500 eventually fell nearly 57%, Burry's Science Capital made around $700 million for his investors. Another one was Jerry Grantham, the co-founder of GMO. In 1999, at the height of the dot-com euphoria, he warned that markets have become the most expensive in history. People mocked him for sitting out on the rally, until the Nasdaq crashed 78% a year later. Investors who listened to him avoided one of the biggest wealth wipeouts ever recorded. Then there's Michael Wilson from Morgan Stanley. In late 2021, when everyone thought the Fed would keep rates low forever, he warned that rising inflation and tightening policy would crush valuations. He turned out to be right. The S&P 500 dropped 19% in 2022, while high-growth stocks were crushed. If investors had acted on Wilson's warning, even just by trimming exposure or rotating into value and dividend names, they could have sidestepped one of the worst single-year drawdowns since the global financial crisis, while possibly catching the rebound that followed just months later. But here's the thing, for every one of those perfect calls, there are hundreds more that will never come true. In a paper titled "Do Financial Gurus Produce Reliable Forecasts?", researchers examined more than 6,000 market predictions made by 68 well-known forecasters on the S&P 500 index. What they found was that only 48% of those forecasts were correct. Meanwhile, 2/3 of the forecasters had accuracy scores below 50%, meaning they were literally worse than random chance. In other words, you could have let the goldfish pick the market direction and probably done better. Then there's another study called Guru Grades, which tracked thousands of predictions made by prominent experts between 2005 to 2012. Across all forecasts, the average accuracy came in at just under 47%. Again, worse than a coin flip. In fact, the results followed a neat bell curve distribution, exactly what you would expect from random guessing. Even the very best gurus only reached about 68% accuracy. If these gurus were Asians, they would have probably been disowned by their parents. So, if acting on the forecast of market gurus isn't likely to be profitable, then what about broader survey forecasts, the kind compiled from economists and strategists across Wall Street? According to the 2023 study titled "How Accurate Are Survey Forecasts on the Market?", even consensus views didn't fare much better. Researchers found that most survey-based predictions failed to outperform simple statistical models that relied purely on historical averages. In fact, many of these forecasts were biased toward optimism during bull markets and excessive pessimism after major sell-offs, meaning they were often reacting to sentiment and not predicting it. But of course, none of this stops people from making forecasts, because in the world of finance, the reward of being right once is far greater than the cost of being wrong 100 times. If your prediction hits, you'll be remembered as a genius. If it doesn't, well, everyone just forgets by the next month anyway. Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. So, just the other day, someone posted in my Telegram channel about Michael Burry making big short bets on both Nvidia and Palantir. And immediately, someone asked, should we follow him? To be fair, this is a good question. After all, this is Michael Burry we are talking about, the guy who predicted the 2008 housing bubble and made hundreds of millions of dollars when the world fell apart. Surely, someone that smart must know what he's doing again, right? Well, here's the thing. Michael Burry loves making bold predictions. In fact, he does it a lot. The problem is, when those predictions doesn't pan out, he has a funny habit of quietly deleting his tweets, deactivating his accounts, and pretending it never happened. only to reappear a few months later with another ominous forecast about the end of the world. Though that hasn't stopped Adam Khoo from keeping score of Michael Burry's predictions. And when you look at them, a very clear pattern appears. In 2015, Burry predicted that the markets would crash. Instead, the S&P 500 rose by about 11% over the next 12 months. In 2017, he warned of a global financial meltdown, and the index went up 19% instead. In 2019, same story. Then in March 2020, he revealed a massive bearish bet right before the market's bottom. Over the next year, the S&P 500 surged 72%, and the pattern continued. In 2021, he warned of another collapse. The markets went up. Same thing in 2022 and in 2023. In fact, even though Burry was right about the 2008 crash, he was actually 3 years early. Back in 2006 and 2007, his fund was losing money. Some even pulled their money out entirely before his big shot finally paid off. And that's the thing about bubbles. You can be right about the story, but completely wrong about the timing. Because as the saying goes, the market can stay irrational longer than you can stay solvent. Still, when it comes to market crash predictions, even Michael Burry looks restrained compared to some of the other doomsday pundits, especially the rich dad poor dad guy, who has made over 10,000 crash warnings in the past 15 years alone. And funnily enough, he just made another one. So if following Michael Burry isn't necessarily the smartest choice, what about Jamie Dimon, the head of JP Morgan Chase? He's one of the most powerful and respected voices in global finance, and lately, he's been warning about another potential crash. But just like Burry, Dimon's record shows how tricky market timing really is. Despite his repeated warnings over the years, the S&P 500 has mostly gone up in the 12 months that followed. In fact, after some of his most dire warnings, like in 2020 and 2023, the markets went on to deliver spectacular double-digit returns. Now, this isn't to say that their concerns are baseless. The risks that they are warning about, rising inflation, government debt, geopolitical instability, and market bubbles are all real. But identifying risks is very different from predicting when those risks will actually matter to the market. Could they be right this time? Absolutely. If you shout about a bubble long enough, eventually one will pop. The question is, how much higher will the market climb before that day comes? And if listening to the doom and gloom crowd isn't the right move, what about going to the opposite direction, like the perma-bull's Tom Lee? He's been one of the loudest optimists on Wall Street. And to his credit, he's been right about much of the recent bull run. But when the 2020 bear market hit, even he got it wrong. So then, if market predictions can't be trusted, where does that leave us? Very often, investors focus on what they can't control. The next crash, the next correction, the next headline that sends everyone into a panic. When the market goes down one day, they'll be like, should I sell now? Then the next day, the market goes up, they'll be like, I'm a genius. I was reading a book titled The Psychology of Money the other day. I don't have it with me because I'm too cheap to buy it. But here's what the author said. Volatility is the price of admission. Like the car, you have a few options. You can pay this price accepting volatility and upheaval, or you can attempt the equivalent of a Grand Theft Auto. Try to get the return while avoiding the volatility that comes along with it. Many people form tricks and strategies to get the return without paying the price. They trade in and out. They attempt to sell before the next recession and buy before the next boom. But the money gods do not look highly upon those who seek a reward without paying a price. Some car thieves will get away with it. Many more will be caught and punished. The average equity fund investor underperformed the funds that they have invested in by 0.5% per year, according to Morningstar, the result of buying and selling when they should have just bought and held. The irony is that just by trying to avoid the price, investors end up paying double. Market returns are never free and never will be. They demand you pay a price. Like any other product, you are not forced to pay this fee, just like you are not forced to go to Disneyland. You can go to the local county fair where tickets might be $10 or stay home for free. You might still have a good time, but you will usually get what you pay for. Same with the markets. The volatility and uncertainty fee, the price of returns, is the cost of admission to get returns greater than low fee parks like cash and bonds. That's the only way to properly deal with volatility and uncertainty, not just putting up with it, but realizing that it's an admission fee worth paying. When people think of Warren Buffett, they picture him as this god of investing, someone who can look at the markets, see what's coming next, and make the perfect move every time. But in reality, there have been many investors who have outperformed him. One of them was Jim Simons, the mathematician behind Renaissance Technologies. His Medallion Fund compounded at an astonishing 66% annually since 1988, compared to Buffett's roughly 20%. On pure returns alone, Buffett doesn't even come close. But that's the part most people miss. Buffett's genius isn't in timing the market, it is time in the market. His wealth didn't come from a few lucky trades or secret algorithms. It came from buying great businesses, holding them for nearly 70 decades, and letting compounding do all the work. And of course, he had to pay the price for it. Throughout the years, Buffett's portfolio has seen massive drawdowns, such as 43% in 2000 and 50% in 2009. But to him, that volatility wasn't a punishment, it was the admission fee for long-term wealth. If Buffett had tried to chase short-term returns the way most investors do, jumping in and out of the market, reacting to every headline, he never would have built the kind of lasting fortune he has today. So what does this mean for all of us? At times like this, you don't need another prediction, you need a plan. We all know that a market crash will eventually come. That's not a bug, it's a feature of the system. The admission fee you pay for earning higher long-term returns. Now obviously, I don't know what your personal financial situation is, so this isn't financial advice. But here's what I'm doing for my own portfolio. Personally, I continue to buy great businesses that have strong fundamentals, one that can grow over time. I want to ideally buy them when they are trading below their intrinsic value or after a major drawdown. At the same time, I'm also dollar cost averaging into a globally diversified fund, such as FWRA, to diversify my risk and capture global growth. And then I simply let time do all the work. In fact, on a selfish note, I actually want a market crash to come because it gives me the chance to buy more stocks at a massive discount. Crashes don't destroy wealth for long-term investors. They simply transfer it from the fearful to the patient. Now, if you like to time the market, that's perfectly fine too. Even I do it occasionally. But just don't use all your capital to do it, because timing the markets wrongly can sabotage your long-term returns. One strategy that I find useful is to buy when there's fear in the market. I use the RSI indicator for this. When it dips below 30, it usually signals extreme fear, and historically, that's when markets tend to rebound. But if you find yourself panicking every time the market drops, that's a sign your portfolio might be too aggressive for your risk tolerance. In that case, you may consider trimming some of your equity exposure and shifting into less crashy assets like government bonds, gold, or even money market funds, so that you can sleep well at night. In summary, crashes are inevitable, and no one, not Michael Burry, not Jamie Dimon, and definitely not you, knows exactly when the next crash will happen. But the good news is that none of us need to know either. All you need is a plan that works whether the market goes up or down or sideways. So don't waste your energy chasing predictions. Spend it on building a system that keeps you calm when everyone is losing theirs. Because in the end, wealth doesn't go to those who predict best. It goes to those who endure the longest. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.